When people hear the name Warren Buffett, they imagine complexity. They imagine brilliance operating at full throttle. They imagine a man processing oceans of information, making impossibly sophisticated calculations, and outthinking everyone else in the room. And when they hear my name attached to his, they imagine something similar. Two intellectual heavyweights locked in permanent analytical combat with the markets. That story is flattering. It is also almost entirely wrong. The reality is far less cinematic and far more instructive. Our edge never came from thinking harder than everyone else. It came from thinking less but better. It came from understanding the limits of human cognition and then arranging our lives and our work so those limits hurt us as little as possible. Most people approach investing as an intellectual contest. We approached it as an exercise in error avoidance. The human brain, for all its capabilities, is fragile in predictable ways. It gets tired, it gets distracted, it becomes overconfident when it has too much information and paralyzed when it has too many choices. And yet modern professional life is designed to push the brain into exactly those failure modes. Endless meetings, constant decisions, a steady drip of data masquerading as insight. By the time an important decision arrives, the mind is already depleted. What fascinated me over time was not how often people made bad decisions, but how systematically they did so. They weren't reckless, they were diligent. They weren't lazy, they were exhausted. They approached decisions already cognitively impaired, then compensated by adding more analysis, more models, more projections. They treated a biological limitation as an intellectual problem that never works. If you want to understand successful investing, you have to stop asking how smart someone is and start asking how they conserve their mental energy. Judgment is not an infinite resource. Every trivial choice you make taxes the same system you rely on for the important ones. What to wear, what to eat, when to check your phone. These seem irrelevant, but they are not. They drain the same battery. Most people don't fail because they lack intelligence. They fail because they squander it. They burn it on decisions that don't matter, arguments that go nowhere, and information that adds no value. Then, when the moment comes that actually counts, they're running on fumes. This is where the myth of overthinking enters. Overthinking is often mistaken for seriousness. People believe that if a decision feels difficult, it must be important, and if it takes a long time, it must be thorough. In reality, many decisions feel difficult because the decision maker is tired, afraid, or overwhelmed by unnecessary detail. Overthinking is not depth, it's noise mistaken for rigor. In investing, this is especially dangerous. The market does not reward activity. It does not care how many hours you worked or how complex your spreadsheet is. It only cares whether your decision was sensible. And sensible decisions are usually simple, uncomfortable, and made without perfect information. That last part terrifies people, so they delay, they refine. They polish assumptions that don't deserve the attention. They wait for clarity that will never arrive. Eventually, the opportunity disappears or mutates into something unrecognizable. When they look back, they tell themselves the story that they were being cautious. Often, they were just avoiding responsibility. The irony is that simplicity, when done correctly, is not naive at all. It is sophisticated restraint. It requires confidence, not in your ability to predict the future, but in your ability to recognize when you don't need to. That kind of confidence is rare because it does not look impressive. There are no dramatic gestures, no heroic all-nighters, just a quiet refusal to do stupid things. That philosophy didn't emerge from theory. It emerged from lived experience, from observing how real humans behave under real constraints. And perhaps the most striking example of this isn't found in a balance sheet or an annual report, but in the daily operating habits of Warren Buffett himself. Which brings me to something that, in retrospect, explains far more about our success than any investing model ever could. Well, what's really interesting on this subject of Warren's operating methods, you can see happening here. We didn't know when we started out this modern psychological evidence to the effect that you shouldn't make a lot of important decisions when you're tired, and that making a lot of difficult decisions is tiring. And we didn't also know as well as we now do how helpful it is to be consuming caffeine and sugar when you're making important decisions. And what happens, of course, is that both Warren and I live entirely on autopilot in terms of the ordinary decisions of life. We're just totally habitual. So we don't waste any decision-making energy on that stuff. Often we're ingesting caffeine and sugar, and it turns out under the modern evidence, this is an ideal way to sit where Warren sits, and when he didn't know that, he just stumbled into it. I cannot remember an important decision that Warren has made. When he was tired, he's never tired. He sleeps soundly, and he doesn't waste time thinking about what he's going to eat. As you say, he just eats what he's always eaten. Oh yeah, his style turns out to be absolutely ideal for human cognition. It looks peculiar, but he stumbled into something very good. Now, people like to believe that great investing comes from great brilliance. They imagine a man surrounded by screens, spreadsheets glowing late into the night, endlessly refining assumptions. That picture is comforting. It flatters the ego. It is also mostly wrong. In my experience, the people who get into the most trouble in investing are often very smart, sometimes too smart. They confuse intellectual activity with sound judgment. They mistake motion for progress. The truth is uncomfortable. Investing does not reward the person who thinks the hardest. It rewards the person who avoids the dumbest mistakes. That distinct ion matters more than most people realize. Overthinking is usually sold as discipline. In reality, it's often fear of wearing a tuxedo, fear of being wrong, fear of looking foolish, fear of acting without perfect certainty in a world that does not offer it. So people analyze and analyze again, and then analyze what they already analyzed. By the time they are ready, the opportunity is gone or worse. They talk themselves into something that looks brilliant on paper and behaves terribly in real life. I've seen this pattern repeat for decades. Most bad investment decisions don't come from ignorance, they come from misapplied intelligence. A smart mind pointed in the wrong direction can do a lot of damage. Warren and I never believed that our job was to make clever decisions. Our job was to make few decisions and make sure they weren't stupid. That's a very different mindset. Modern culture celebrates complexity. If something is simple, people assume it must be naive. If it's hard to explain, they assume it must be sophisticated. Investment bankers are particularly fond of this illusion. Give them a declining business and they'll still project rising earnings. After all, nobody sells a deal by saying this will probably get worse. But slowly, we never had that problem. We were perfectly willing to buy businesses where earnings were going to decline if the price was right and the effort required was minimal. That alone eliminates a shocking amount of overthinking. The brilliant decision maker believes his edge comes from forecasting the future. The experienced decision maker knows the future is mostly noise and focuses on avoiding obvious errors in the present. That's not pessimism, it's realism. Overthinking often starts with a false premise that more information always leads to better decisions. It doesn't. At some point, additional information doesn't clarify, it confuses. It introduces conflicting signals, marginal distinctions, and false precision. You start optimizing decimals while missing dollars. I've watched people destroy perfectly good ideas because they couldn't stop refining them. They kept asking one more question, running one more scenario, waiting for one more data point. Eventually, the opportunity expired. There's a reason Warren and I never tried to predict macroeconomic cycles, interest rates, or next quarter's GDP. It's not because those things don't matter. It's because they're hard to predict reliably, and pretending otherwise encourages overthinking of the worst kind. Instead, we preferred obvious logic. Is the business understandable? Is the balance sheet strong? Is the price sensible? Is the downside survivable? If those boxes were checked, we didn't need a 200-page report to feel intelligent. We needed the courage to act and the discipline to stop thinking. That last part is underrated. People assume the hardest part of investing is analysis. It isn't. The hardest part is knowing when further analysis makes you worse. Overthinking also feeds the dangerous desire to be right rather than to make money. Once your ego is involved, you start defending your ideas instead of evaluating them. You look for confirmation, said a truth. That's how smart people stay poor. Warren once joked that he couldn't remember an important decision he made while tired. That wasn't an accident. Good judgment requires a rested mind. Overthinking usually happens when the mind is already fatigued and looking for certainty it can't find. The brilliant decision maker believes effort equals virtue. If a decision took months of work, it must be good. Reality doesn't work that way. Some of our best decisions took minutes, not because we were reckless, but because the logic was clearer and the alternatives were worse. Simplicity is not stupidity. It's often the byproduct of long experience. If you've lived through enough cycles, you stop romanticizing complexity. You learn that most things don't need to be optimized. They need to be avoided. Avoid leverage you don't need. Avoid businesses you don't understand. Avoid partners you don't trust. Avoid decisions that require you to be a hero. Do that consistently, and you'll outperform a lot of people who spend their lives trying to be clever. So when I hear investors brag about how much time they spend thinking, I don't feel impressed. I feel nervous for them because in investing, brilliance is optional, but discipline, restraint, and knowing when to stop thinking, those are mandatory. And if that sounds too simple, well, that's usually the first sign you're overthinking. Again, one of the great flaws in how people think about Decision M is that they assume the brain works like a machine. You turn it on, it runs at full power, and as long as you keep feeding it information, it keeps performing. That's nonsense. The human mind is more like a battery. Every serious decision drains it. And once it's drained, the quality of your judgment collapses, often without you noticing. Modern psychology eventually figured this out. Warren and I discovered it the old-fashioned way by watching people make terrible decisions late in the day, including very intelligent people. Decision fatigue is not dramatic. It doesn't announce itself. You don't feel stupid. You feel thoughtful. That's what makes it dangerous. By the time people start overthinking, they are usually already tired. They don't realize it, so they keep pushing more spreadsheets, more scenarios, more just one last look. What they're really doing is asking an exhausted mind to do precision work that never ends well. This is why Warren's lifestyle, which people love to mock, turns out to be almost perfectly designed for sound judgment. He doesn't waste mental energy on trivial decisions. He doesn't stand in front of a closet deciding who he wants to be today. He doesn't debate food choices like it's a moral exercise. He eats what he's always eaten. He sleeps when he's tired. He wakes up rested. People think that's lazy or eccentric. It isn't. It's disciplined. Every unnecessary decision you eliminate preserves energy for the decisions that matter. That applies to life, and it applies even more to investing. Overthinking is often the symptom of cognitive overload, not intellectual rigor. When the brain is fresh, good ideas feel obvious. When the brain is tired, everything feels complicated. That's why people get lost in nuance at exactly the wrong moment. They start arguing about small differences while ignoring the big picture. I've watched investors debate valuation multiples down to the second decimal place while missing the fact that the business itself was mediocre. That's fatigue talking. There's a reason Warren couldn't remember making an important decision, clears throat while tired. Important decisions deserve a fresh mind. If you can't wait until tomorrow, the decision probably isn't as urgent as you think, or you're about to do something foolish. This connects directly to overthinking. Most overthinking happens late in the day, late in the process, late in the emotional cycle. By then, people aren't searching for truth. They're searching for relief. They want certainty so they can stop thinking, but certainty is not available. So they keep grinding and grinding. Eventually, they convince themselves of something, not because it's correct, but because they're exhausted. That's how intelligent people talk themselves into bad investments. The antidote is not more intelligence. It's fewer decisions. Warren and I always believe that you should save your Decision M capacity, the way a pilot saves fuel. You don't burn it taxiing in circles on the runway. Most people do exactly that. They exhaust themselves on small, reversible choices. Then when a large, irreversible one arrives, they're depleted. At that point, overthinking becomes inevitable. The brain sensing danger slows everything down. It demands more information. It creates doubt that feels prudent. It often isn't. Good judgment requires both rationality and timing. If you wait until your mind is worn out, you're already late. This is one reason we favored habits and routines so strongly. Not because routines are virtuous in themselves, but because they remove friction. Autopilot is not stupidity. Autopilot is conservation of scarce mental resources. You want your best thinking available when it matters, not squandered on trivia. In investing, this means you don't constantly tinker. You don't monitor prices all day. You don't react to every piece of news. That behavior feels active. It feels engaged. It is usually just exhausting. The market is very good at draining your energy if you let it. Noise is cheap. Stimulation is constant. If you consume all of it, you will overthink by default. And when you overthink, you stop seeing the obvious. The obvious is where most of the money is made. Simple mispricings, plain incentives, clear human behavior. Those things don't require brilliance. They require a calm mind. So if you want to improve your investment results, don't start by reading more books or building more models. Start by protecting your judgment. Sleep, simplify. Reduce the number of decisions you make in a day. And above all, recognize this. When your thinking starts to feel heavy, tangled, and desperate for certainty, that's not a sign you should think harder. It's a sign you should stop, because an exhausted mind doesn't need more analysis. It needs rest and fewer decisions to make. One of the most persistent mistakes in investing is the belief that a good investment must sound exciting. People want a story. They want growth curves pointing up and to the right. They want something they can brag about at dinner. That desire alone eliminates a vast number of perfectly rational opportunities. Warren and I never required excitement. We required sense. If an idea could be explained in a few sentences and those sentences held up under scrutiny, we were interested. If it required a long presentation to justify why reality might eventually cooperate, we usually passed. That approach saved us a great deal of trouble. Consider our investments in newspapers. To many observers, this looked irrational. The industry was in decline. Circulation was falling. Advertising was moving elsewhere. All true. What confused people was that they assumed we were trying to buy a growth story. We weren't. We were buying assets at very low prices relative to current earnings, with the clear expectation that earnings would decline but not collapse, and that the capital required to operate the business would remain modest. That's not romance, that's arithmetic. Most investors are trained to reject declining businesses on principle. They've been taught that shrinking earnings automatically mean a bad investment. That's lazy thinking. A business with declining earnings can be a perfectly good investment if the price more than compensates for the decline. The reverse is also true. A growing business can be a terrible investment if the price assumes miracles. This is where overthinking quietly enters the picture. People build elaborate models to predict growth 10 years out. They argue over terminal values. They debate scenarios that are unknowable. All of that intellectual effort is focused on the wrong question. The right question is simpler. What do I have to believe for teach? Is investment to work? In the case of newspapers, we didn't have to believe in a renaissance. We didn't have to believe in digital dominance. We didn't have to believe anything heroic. We only had to believe that the decline would be gradual and that the business would continue to throw off cash for a long time. That was not a stretch. Investment bankers, of course, never sell deals that way. Their books always show rising earnings. Decline is quietly edited out. Reality is less cooperative. Warren once pointed out the irony. When we buy businesses, we often expect earnings to go down. When others sell businesses, they expect earnings to go up, at least on paper. Guess who usually has the advantage? Simple ideas have another virtue. They don't require constant supervision. The newspaper investments didn't demand extra attention from headquarters. They didn't require new systems or heroic management interventions. That matters. A decent return that requires no additional effort is often superior to a potentially higher return that demands constant mental energy. Most people underestimate the cost of attention. They see only the numbers. They ignore the wear and tear on judgment. Warren was very clear about this. The newspaper investments would never move the needle at Berkshire. They were too small, but they didn't have to. They were rational. They were purchased at sensible prices. They carried limited downside. That was enough. Overthinking thrives when people believe every decision must be extraordinary. It doesn't. A portfolio built from a series of good enough decisions will outperform one built from a few heroic ideas that require perfect execution. The obsession with brilliance causes investors to overlook opportunities that look dull. And dull opportunities often come with one critical advantage: fewer competitors. Most people can't stand them. They'd rather low. SE money in something exciting than make money in something boring. That's not an accident. It's human nature. But investing is not a popularity contest. It's a weighing machine over time. Simple logic applied consistently beats complex logic applied occasionally. If you find yourself attracted to an investment because it makes you feel clever, that should worry you. Feeling clever is not a reliable indicator of future returns. Warren and I were always more comfortable with ideas that made us feel calm. Calm means the logic is clear. Calm means the downside is tolerable. Calm means you don't need to revisit the decision every week to reassure yourself. Overthinking, by contrast, keeps you emotionally entangled. You're always checking, always second-guessing, always adjusting assumptions. That's a sign the idea was fragile to begin with. Good investments don't require constant intellectual maintenance. They work because the underlying logic is sound, not because you keep repairing it. So when you evaluate an opportunity, don't ask how impressive it sounds. Ask something far more important. If this turns out to be merely adequate, am I still satisfied? If the answer is yes, you're probably thinking clearly. If the answer is no, you may already be overthinking and setting yourself up for disappointment. One of the great diseases of modern investing is the pursuit of perfection. People want the perfect entry price, the perfect business, the perfect forecast. They don't realize that perfection is usually just procrastination in a nicer suit. Warren and I never tried to make perfect decisions. We tried to make decisions that were clearly better than the alternatives. That difference sounds small. It isn't. Perfection requires complete information. Complete information does not exist. So the investor who demands it is guaranteed to wait too long or never act at all. This is where overthinking quietly destroys returns. People sit on cash because nothing snorts feels perfect. They keep refining their criteria. They raise the bar until no real-world opportunity can clear it. Meanwhile, time passes. Inflation works. Opportunities compound elsewhere. The cost of inaction is rarely visible, which is why it's so dangerous. At Berkshire, we never required every investment to move the needle. If we had, we would have done far fewer sensible things. Some investments were simply decent uses of capital. They didn't require genius. They didn't require constant attention. They didn't require us to be heroes. They were good enough. That's a concept many investors struggle with. They assume that because Berkshire is large, every decision must be extraordinary. In reality, the discipline was the opposite. Only extraordinary errors were unacceptable. A modest, low-risk return that requires little effort is often superior to a potentially spectacular return that demands flawless execution. Overthinking flips that logic on its head. It convinces people that unless an idea is exceptional, it isn't worth doing. So they reach, they add leverage. They accept fragile assumptions. They stretch timelines all in the name of being right. But investing does not reward elegance. It rewards endurance. A portfolio doesn't collapse because it lacks brilliance. It collapses because it contains too many fragile ideas. Fragility often hides behind sophistication. If an investment requires everything to go right, it is not a great investment. No matter how clever the thesis sounds, we preferred investments that could tolerate disappointment. If growth slowed, the investment still worked. If margins compressed, the investment still worked. If management made a few mistakes, the investment still worked. That is what good enough really means. It doesn't mean careless. It means robust. The pursuit of perfection also leads people to ignore scale and effort. They focus entirely on return percentages and forget to ask how much attention the investment will consume. A 12% return that requires no mental bandwidth can be far superior to a 15% return that keeps you awake at night. Most investors never factor that in. They should. Mental energy is a finite resource. Once it's gone, mistakes follow. Warren once remarked that some investments were attractive precisely because they didn't require an extra ounce of effort from headquarters. That wasn't laziness, it was rational allocation of attention. If an investment doesn't distract you from more important decisions, it has hidden value. Overthinking blinds people to this trade-off. They see only the upside scenario. They ignore the ongoing cost of involvement. There is also a social element to perfectionism. People want to be admired for their decisions. A good enough investment doesn't earn admiration. It earns indifference. That bothers people. So they choose complexity. They choose novelty. They choose ideas that sound impressive, and they accept risks they don't fully understand. Warren and I had no interest in admiration. We were interested in results. If something worked quietly year after year, we were satisfied. In investing, boring is often beautiful. The irony is that once you accept good enough, decision-making becomes easier, not harder. You stop chasing ideal conditions. You stop waiting for clarity that will never arrive. You act when the odds are favorable, not perfect. That's how capital compounds. So if you find yourself endlessly refining an idea, adjusting assumptions, and waiting for conditions to line up just right, pause. Ask yourself a simple question. Am I trying to avoid being wrong or trying to make money? Because the investor who insists on perfection usually achieves. Neither. Overthinking doesn't only show up in stock selection. It shows up even more clearly in how people try to control outcomes. The more insecure someone is about their judgment, the more they interfere. They monitor constantly. They second guess us. They demand updates. They call this risk management. Most of the time, clear as throat, it's just overthinking with authority. Lauren and I took a very different approach when we brought Todd and Ted into Berkshire. We didn't hire them to imitate us. We hired them because they had judgment. And once we decided that, we stayed out of their way. We didn't tell them how many stocks to own. We didn't tell them what industries to avoid beyond a few legal constraints. We didn't tell them how to diversify. They could put all the money into one stock if they wanted. They could own 50%. That freedom shocks people. They assume such autonomy is reckless. In reality, it's a filter. Only someone with genuine discipline can operate well with that kind of responsibility. Micromanagement is a form of overthinking that spreads. It doesn't just exhaust the person doing it, it weakens the people being managed. If every decision is second-guessed, clear as throat people stop thinking independently. They start optimizing for approval instead of outcomes. That's how organizations lose judgment. The same thing happens to individual investors. They ask 10 people for opinions. They read 20 commentaries. They wait for consensus. By the time they act, they're not following their own reasoning anymore. They're following the average of other people's anxieties. That is not diversification. That is delusion. When Warren managed money earlier in his life, he wanted one thing above all, freedom to act. If people wanted to give him money, they could decide that. But once they did, he didn't want his hands tied. That principle never changed. Responsibly. Thank you without authority is a recipe for bad decisions. Authority without trust is worse. Overthinking thrives in environments where no one feels fully accountable. When everyone is half responsible, judgment disappears. Delegation done properly reduces overthinking because it forces clarity. You either trust someone or you don't. If you don't trust them, don't give them the job. If you do trust them, don't suffocate them. There is no middle ground that works for the individual investor. This lesson applies internally. You have to decide whether you trust your own process. If you don't, no amount of external confirmation will fix that. You'll just borrow other people's confidence temporarily. Eventually, you'll face a moment when opinions diverge. They always do. At that point, overthinking rushes in. You hesitate, you reevaluate, you freeze. Not because the situation changed, but because you never fully owned the decision to begin with. Warren and I were comfortable being different. We bought things others avoided. We ignored things others loved. That wasn't contrarianism for its own sake. It was the natural result of independent thinking combined with trust in our judgment. Micromanagement destroys independence. Overthinking destroys decisiveness. Both come from the same source, fear of being wrong. But investing doesn't allow you to outsource responsibility. You can listen to others. You can learn from them. But the final decision has to be yours. Once it is, constant interference only makes things worse. That's why we didn't hover over Todd and Ted, and it's why we didn't constantly tinker with our own investments. We made decisions. We lived with them. We adjusted only when the underlying facts changed, not when emotions did. That discipline is rare. Most people confuse activity with control. They confuse involvement with insight. True control comes from selecting. Well, not from interfering endlessly. If you find yourself constantly checking, constantly adjusting, constantly seeking reassurance, ask yourself why. Is the investment actually fragile? Or is it your confidence that is because no amount of micromanagement will fix the second problem and overthinking will only make the first one worse? After all the talk about intelligence, analysis, and discipline. Investing eventually comes down to something far less glamorous, knowing when to stop. Most people never master that skill. They assume wisdom means continuing to think, continuing to refine, continuing to search for certainty. In reality, wisdom often means recognizing that further thinking will not improve the decision and may actively harm it. Warren and I saw this most clearly during periods of crisis. Take the Harley-Davidson deal during the financial meltdown. The corporate bond market was frozen. Panic was everywhere. We didn't build a decade-long forecast for motorcycle demand. We didn't model lifestyle trends. We didn't speculate about brand relevance in 2030. We asked a much simpler question. Is this company going to go broke? If the answer had been yes, we would have walked away. If the answer was no, and we believed it wasn't, then the terms being offered were extraordinary. 15%. You don't need brilliance to understand 15% in a world starving for capital. You need nerve and restraint. Restraint to not overthink yourself out of the obvious. That's the paradox many investors never resolve. The clearer an opportunity is, the more people feel compelled to complicate it. They add conditions. They add caveats. They invent risks that weren't there before. Not because the risks are real, but because acting feels too easy. Easy decisions make people suspicious. They assume they must be missing something. Sometimes they are. Most of the time, they're just uncomfortable with implicity. The skill is learning the difference. We always believed that if an investment required constant explanation to ourselves, it probably wasn't good enough. A sound decision should settle the mind, not agitate it. That doesn't mean there's no doubt. There's always doubt, but there's a difference between healthy uncertainty and mental noise. Healthy uncertainty says, I understand the risks, and I can live with them. Mental noise says, I don't really believe my own reasoning, so I'll keep circling. Overthinking lives in that circle. At some point, the information stops changing, but your emotions don't. You start reacting to your own anxiety instead of the facts. That's when you should stop. Another mistake people make is believing that great investors are constantly active. They aren't. Most of the money is made by waiting for mispricing, waiting for panic, waiting for stupidity, which is never in short supply. When the moment arrives, the decision should be relatively quick, not impulsive, but decisive. If it takes months of agonizing to convince yourself, the odds are the opportunity isn't as good as you think, or you don't trust your framework. Either way, thinking longer won't fix it. Warren once said that investing is easy to explain but hard to do. This is why the explanation fits on a napkin. The execution requires emotional control. Knowing when to stop thinking is part of that control. It means accepting that you will sometimes be wrong. It means resisting the urge to optimize every outcome. It means acting when the odds are favorable, not perfect. Most people never do this because being wrong feels worse than missing an opportunity. That's backwards. Miss enough opportunities, and your future is decided quietly without drama. Warren and I never believed we had to be right all the time. We believed we had to be right when it mattered. That requires selectivity. And selectivity requires the discipline to say no, not just to bad ideas, but to unnecessary thinking. So here is the unglamorous truth. The hardest part of investing is not learning how to think. It's learning when to stop, when the logic is sound, when the downside is acceptable, when no new information is likely to change the conclusion. That is the moment to act. If you hesitate, then you're not being cautious. You're being afraid. And fear dressed up as analysis is still fear. The investor who understands this doesn't look busy. He doesn't look clever. He often looks bored, but over time, boredom compounds in overthinking.